fundsupermart.com.
Hello everyone. With us today is James White, Senior Analyst in the Economic and Market Research team at First Day Investments, to share with us his global market outlook. Hello James, thanks for joining us. As the market digests the U.S. Federal Reserve's tapering plan, what's your view on the global market trend going forward?
I think that based on what we understand from the Federal Reserve from last year and earlier this year, the sort of economic goals that they've been trying to pursue haven't been reached. So unemployment is still too high and inflation is still too low based on the communication of the Federal Reserve over the last year and a half. They shouldn't be doing tapering at the moment. However, and I think the reason why there will be tapering is because there's been a change in the governance of the Federal Reserve, but in particular we think that it's more than likely that Ben Bernanke won't be chairman next year and Larry Summers will be. And Larry Summers has clearly indicated that he believes that quantitative easing has not been as effective as it should be, that it has benefited some parts of the economy more than others, and he believes that it should probably be ended relatively quickly. And I think this is a view that markets haven't had, really, and so we need to see more evidence of exactly what's guiding policy and what's going to guide policy in the future before we see some sort of stability in markets. So I think the volatility around who's going to be the next chair of the Federal Reserve, plus the fact that we are going to have some tapering and we're not quite sure what the impact of that tapering will be, means that over the next 6 months we'll have quite a bit of volatility. In terms of markets, I think what we've seen is the United States market is starting to look quite expensive relative to the short term. And I think that also with interest rate expectations not being clear, it's not hard to imagine a world in which US equities are probably a bit lower than where they are for the next 3 months or so. So I think we'll probably see some fall away in asset prices in the US. But I think elsewhere in the world there's some arguments to say that you might see some higher ones, particularly Europe. I think Europe, it looks a little bit more attractive. They've got a stable monetary policy. The monetary policy hasn't been particularly aggressive, but at the same time it is starting to work. It's one of the most important aspects of what's happening in Europe is the fact that European banks are able to recapitalise themselves because their assets, the assets against which they've lent money, are starting to appreciate in value. So the European situation looks better than it has done for a while. And I think while there's still political risk in Europe, I think European markets might outperform relative to the United States in the next couple of months, certainly the rest of the year.
Looking at the emerging markets, what will be the currency trend for the region as a whole?
Look, I think it'll be interesting. I mean, obviously, there's a whole lot of different stories in Asia in terms of currencies. I think the Chinese currency bloc will be relatively strong still. I mean, I think obviously tied to the US dollar, and one of the things that will come out of this period of uncertainty with the US dollar is a high, with the US economy and the Federal Reserve, is a stronger US dollar. So I think those sort of countries that are able to maintain a peg with the US dollar will see their currencies appreciate relative. But I think, in an emerging Asia and Southeast Asia in particular, I think we're going to see some problems, and I would include India in that. I think that the central banks in Indonesia and India in particular haven't offered a credible solution to what amounts to a balance of payments problem. Effectively, what's happening is that these countries are importing more than they can afford at the moment, and markets are starting to sell aggressively their currencies. And I think we're probably at a point where we're in at least a mini crisis in a lot of emerging Asia, because these central banks need to respond to the fact that their currencies are weakening, and they need to be able to afford what they need to buy, and to do that sustainably they're probably going to have to raise interest rates. As they raise interest rates, the currency can start to appreciate, but it's going to be difficult because you're going to have a weak economy by raising rates. So I think that a lot of emerging Asia is probably in a bit of trouble at the moment, and that's why we like developed markets. I think emerging market currencies, to an extent, are really going to suffer over the next 6 months.
What are the key risks investors should be aware of?
Look, I think, as I said, I mean, a lot of it, economies have become run, and markets in particular, become run by central bank policy, and so central bank policy is a real issue. I think that the emerging markets are the ones that face the biggest problems because they're going to have to make really hard choices. I mean, the reality is that the United States might start to taper, might start to raise interest rates in the next 18 months, but it's a choice that it is making, and it's making that choice on its own terms. Central banks in East Asia and Southeast Asia and other parts of the world in the emerging markets are being forced to make these changes. So central bank policy is potentially a risk, but it's one that in the developed world, it comes from a position of strength. I think there are political risks around the world. I think Europe is a really good example. As I said, I'm really comfortable with the idea that European markets probably go higher here on the basis of the fact that asset prices are appreciating, and that's a response to lower interest rates and what seem like sustainably lower interest rates. But the reality is, unfortunately, that large parts of these populations in Spain, in Portugal, Greece, Italy are unemployed, and I don't think that the price of assets going up is necessarily going to lead to higher employment in these economies. And that's a real problem, because I think one of the issues that might become more and more a problem globally is inequality. And so that's the inequality between the rich and the poor. I think in the United States, we've actually seen that inequality diminish a little bit over the course of the last year, and I say that for two reasons. One, the US dollar's appreciated, so everyone in America is able to afford more with their income. And the second thing is that you see house prices rise. Over the last 4 years, we've seen strong rises in equity prices, but that only benefits the top 10% of Americans. When your house price rises, it benefits probably about 60% of Americans. So it's much more even spread of wealth, and that's a better outcome for the US. In Europe and in Japan, I think what we're seeing is that actually, the wealthy are doing really well, but particularly in Japan, poorer people, those people on fixed incomes, are actually seeing their purchasing power fall, and they're not exposed to the rising asset prices. So for them, I think that's a problem. So I think, unemployment in Europe is a problem. I think that higher inflation in Japan is actually a problem for a lot of old people. That makes politics a real risk going forward.
Which country or sector are you more in favor of in the second half of the year? And what are the growth drivers?
Look, I think the countries I like at the moment, I think from an equity investment perspective, as I said, I like Europe most. There is political risk there, but I think Europe's probably the place where I think things are probably going to be best in terms of market performance, and mainly because it's such a surprise, I think, from what we've seen over the last 3 or 4 years. Beyond that, I like, I think the US recovery is quite sustainable, and so that's good. I also think there's probably going to be a bit of a rise in commodity prices, because I think what we're seeing is we are seeing some pickup in growth globally, and it's occurring across all different economies. So part of that growth model might be a bit unfair, but I think it is going to mean higher levels of activity. So I like some of the commodities as well.